What's up, my friends? Happy hump day out there. All right. So the Fed spoke today about policy. This is what we were anticipating yesterday. I would say pretty decent action in the mortgage bond market and mortgage rates versus federal funds rate. We're going to have to explain that now. It's going to be time for us as professionals. If you're a realtor, if you're a lender, I know some loan officers watch this stuff. It's time to start explaining that to people because it gets very confusing, the correlation between when the Fed raises rates, what happens with mortgage rates, et cetera. While it may be in lockstep this time, it isn't always. And so we have to educate people about how this stuff works. Very interesting day today, though. Remember when I said, hey, today could be really, really bad, or it could be explosive either way, depending upon what they say. Turned out the market really was okay with what happened today. So we'll first take a quick look. By the way, Derrick here, VA Home Loan Specialist, NMLS 155010. Get rid of that guy. All right, let's take a look at this real quick. It's going to be a relatively quick video today, but I do want to explain the difference between when the Fed is raising rates versus when they are making asset purchases and how those affect the different types of rates you're going to see. So quick look at the financial markets. Dow's up 1%, S&P 1.5%, NASDAQ 2%, Russell 1.6%. Pretty good. Pretty good for those who own stocks. Bonds today relatively unchanged. Oil is hanging around that $70 mark, now at 71.5. Gold, nowhere. Crypto popped today, which the one thing I was excited about yesterday was the fact that crypto was up when the market was down. That's what people who own crypto want to see. But, you know, today everything's up, crypto's up. Okay, hey, we're not going to be upset about an up day. Getting a little 3% action in the Bitcoins today and 5% in Ethereum. You don't hate that, right? So looking good today across all financial markets. Now, a couple things. I do believe this is somewhat of a head fake. The Federal Reserve today essentially announced they're going to very aggressively, and we called this yesterday, by the way. If you saw yesterday's video, I had the leaked document from Goldman Sachs, their private client document that I shared with you because I'm not a private client of Goldman Sachs. I snatched it too, and they got it exactly right. So they said everything exactly correct, timelines and everything. Go figure, right? What I say? Goldman Sachs super plugged in. The big boys, listen, they always know what's going on before you and I do. The good old boys backroom deal stuff has been going on forever. So you can be mad about it, or you can just pay attention to what's going on and, make good decisions based on that. So they're going to aggressively dial back. What does that mean? They're going to reduce their purchases. Their taper is going to be very aggressive. Exactly what we pointed out yesterday. Go from 30 billion or 15 billion, reduce it per month, 30 billion, reduce per month. They're going to be out of asset purchases some point in the middle of next year, it looks like, if they keep that up. There's still decisions to be made. No, now they're just saying, hey, these are our plans. They could still change things, but the expectation is that this is needed. So the Federal Reserve has basically announced today that they are no longer going to be a part of the problem of inflation. They are going to start becoming part of the solution. This is good for stability in the markets, and I think that is how it was received. I also think that there was potentially some fears in the market that they could say something really bad and really even more aggressive than what they said. And so that's why we're seeing an update today. But I believe it's a head fake. I really do, especially on the stock side. Let's take a look. Oh, here we go. Majority of Fed members forecast 3 interest rate hikes in 2022. Okay, so what interest rates are we hiking? There's two different ways that the Federal Reserve impacts interest rates. And there's two different worlds of interest rates. There's the bond world. Okay, bonds, usually treasury bills, T-notes, whatever you want to call them. And the 10-year treasury, sometimes they'll buy longer-term treasuries. They do this because they essentially have free money. They make money, right? They just create money. And they go and they buy these stable assets and sort of manipulate the interest rates, but keep them at a reasonable level. And so with that, you have the bond market, which also impacts mortgage rates. And so they are a buyer of bonds. That's one way that they impact. That's how they keep rates low. The federal funds rate, also known as the overnight lending rate, which is the rate at which the Fed will loan money to a bank like Bank of America or whoever, that is directly determined by the Fed. So imagine they make create money from nothing, cost them zero, and then they can lend it out. Pretty good business model, yeah? So they will give money to the banks via this overnight lending window. And they charge a small amount of interest because they expect the payback to be relatively quick and for it to really just be a way of providing liquidity to the banks. That's really all it is. There's certain reserve requirements the banks must meet in order to determine how much money they're going to be able to get, but all the banks will be able to get some, and usually it's a 15 or 20 to 1 ratio of reserves versus what they're being loaned. So there is leverage there, but the bottom line is they directly control that. That is the rate, the overnight lending rate. That's the interest rate hike that we're talking about. What does that affect? Car loans. That affects your savings account. What the interest you're going to earn on your savings account is. That's going to affect credit card rates, okay, personal loans, those kinds of things, home equity lines of credit. Any rates that are adjustable will likely be impacted by this if you have an adjustable rate of some sort, mortgage or not. So those are the things that are affected by that federal funds rate. Mortgage rates are determined by mortgage bonds. This chart I always show you, provided by Barry Abib and the MBS Highway team. Get this out of the way for my own sake here. Karen, I see your comment and I will get to it. Heard as high as a hike of 35%. I'll talk about where I think this is headed in just a second. Thank you for the comment. Okay, so we lost 17 basis points today. So 2 days ago, we were right here, had a decent day. This is Monday, Tuesday, Wednesday. So notice on Tuesday and Wednesday, they're both red days, meaning we lost ground. Okay, yesterday, I can't remember, I think it was 10 basis points or 9 basis points. Today, that's my homie calling. Hold on one second. Let me tell him what's up. All right, so we had a decent day on Monday, right? We had a green day. But notice the wicks here. So we see these are really good looking candles, actually. They're bullish candles. And I'll tell you, on a day like today, where the Fed is saying, hey, we're reducing it, they're exiting the purchases that they've been making in this market, and they're going to be doing it very aggressively. For bonds to be stable today, I got to tell you, that's a great sign. 17 basis points is no fun to lose, but that's pretty stable in comparison to many other days that we've had where news has not been nearly as bad. So I think that what we can surmise from that is that the vast majority of this announcement was already priced into the market. That's good. That's really, really good. We don't know if that's 100% true yet, but it sure appears so. Today would be the day, right? Today would be the day. Now, they're still going to be purchasing these securities for some time, so it's not like they're out of here altogether. Maybe the big sell-off will come once they are absolutely done purchasing. That could be, but it buys us time nonetheless from an interest rate perspective. So I like these two candles. I do. We've got resistance overhead here in several places. It's not fun, and now this has become resistance too. So there's a lot of headwinds here. We have this downtrend that's holding pretty almost right to the money. That we've got to get through that first. That's step one if we want to see bonds go higher. Because remember, bonds going up like this means rates go down. When bonds go down like this, that means rates go up. So we want to see these prices go higher. Here's what we are seeing though, and this is probably the most encouraging thing I have for you. We are seeing higher lows. So you'll see here, actually I don't know if I drew this one perfectly. So we're seeing higher lows. So we're stair-stepping up on the low. What does that mean? Not a whole lot just yet. Let's see what happens, because we're also seeing here a bear flag is in play. And this may or may not mean a whole lot. We'll just have to see what happens. But there's a bear flag here, which is not good. Which usually would lead you to believe. Again, I'll restate, like I said yesterday, that bond prices should go lower. But after the action the last 2 days and the fact that we got a couple nice looking candles here, the big announcement today was not good from a bond perspective. If you are a bond owner, particularly a mortgage bond owner, you would not be excited about what you heard today, but maybe the sellers are already gone. Maybe they're out of here already. Maybe the traders, maybe the sell trade is already over. And that's our best case scenario. So as unexcited as I am about the announcement, I am a little bit pleased with the fact that we didn't have a total bloodbath today. That is a good thing. So what could happen to mortgage rates? I think it's the question that Karen's trying to ask here. Hey, I heard the hike is going to be 35%. Well, percentage-wise, it's going to be more than that, because right now the overnight lending window is like 0 to 0.25%. They're talking about raising 3 times. I mean, they'll probably get to like a 1.5%. Still super low, right, for a federal funds rate. What will happen with mortgage rates is I think we're going to be pretty stable here. They're probably going to be trickling higher, which is good. That's the way rates should go up, as a trickle. Should be trickling higher until the Fed exits. When the Fed exits, then I think we're going to go back to 4+% mortgages. And that's probably where a really healthy market would be. Somewhere between 4 and 5% for mortgage. That's a healthy market. And I think the 2-something% mortgages, the 3-something% mortgages, 2% just won't happen anymore. 2-something, getting a rate that begins with a 2, that's probably going to go away. Maybe middle to end of next year. That's probably my most optimistic viewpoint. And, we'll probably see towards the end of next year, we'll probably see a lot more rates in the 3s and getting into the 4s. That's just probably what we're going to see. So let's just be prepared for that. Let's understand that's the situation that we're in. So far, what the markets are telling us is that we don't have a major calamity around the corner, but we do know down the line that we're going to face some really tough sell pressure when we lose our big buyer in the Fed, who's been our protection. In fact, it really looks like it's the Fed who was protecting today. If you'll notice, remember we talked about this line right here as being what I was calling, this must be like the Fed draw in the sand line. You've got this 50% retracement Fibonacci here, which is huge. And then coinciding to that is like the perfect double support area, 50% retracement on the Fibonacci right here. And then you also have down here, if we go back, I'll just give you a quick reminder. Let's see if I got it. I didn't even zoom out. Let's see if I nailed it. No, actually it was higher. It was up here. This is kind of that number, like right here, somewhere in there, maybe a little bit lower. That's where there seems to be a lot of support. Right now, that is sort of resistance, but we see those wicks on those recent candles showing us that the buyers are stepping up, and they are in there. Now, is it just the Fed that's in there? I don't know. That's the one thing we don't know. But there are buyers. So expect, like right now is the time. From a refinance perspective, refinance. If you want to do it, look at doing it now. If it doesn't make sense to do it, don't do it. If it does, don't sit around and think, oh, well, rates are going to drop, like I'll wait. That's not going to happen. I don't have a catalyst for you for rates to drop. Let's put it that way. I think rates are just going to go up. Now, there's going to be more fluctuation in the marketplace. That's the expectation. As we get news, as they begin to execute on these tapers and all these different things, you're going to see lots more fluctuation. So there will be opportunities when bonds spike high to get locked in. There will be bad days, when bonds dip that you don't want to get locked in. But overall, this trend is going to continue lower. Bond prices are going to continue to go lower. They're going to get closer to coupon rate. Right now, you can see we're still at 102 or 101.95. So they're not even at 100 yet. There's a lot of room for these to go down and for it all to still make total sense. I mean, we could lose almost 200 basis points and this would still make total sense for us to be there. So let's just keep that in mind when you're looking at your forecast for expectation. The big question is, will a rise in interest rates cause prices to depress? And I don't think in a low inventory market like San Diego we'll see as much of that, if any. Maybe some other areas of the country we could, but I just don't think we're going to see that here in San Diego. Look, we've got so many qualified buyers who have been trying to buy, having a hard time buying. There's so many cash offers out there. There's so many overqualified buyers out there. Just so little inventory, and they're not building the inventory that people want right now. They're building inventory that's luxury. I mean, that's what builders are building. They're building luxury inventory. That's not first-time buyer inventory. That's not, traditional buyer inventory. A lot of it's on the outskirts. I mean, it's a scenario where I don't have a catalyst for prices going lower, and I don't have a catalyst for rates going lower. And I hate to be the messenger on that, but that's just where we're at. So we'll do, hopefully before the end of the week, I'll go through and we'll look at the numbers just kind of for the final time of the year. Hey, here's where we're at on the stats that really matter for the San Diego real estate market. We'll take a look. I'll do some pricing. We'll start pricing some loans on these videos. I want you to see how it works. I want you to understand what we're looking at. I'm going to peel the curtain back a lot in 2022 on all the stuff. If you think I'm transparent now, just you wait. We're going to completely get naked on this freaking thing. Not physically, but I'm going to show you basically everything. Everything that's going on behind the scenes in the mortgage market, just my own access that I have to different institutions for lending, all that stuff. We're going to show you everything. I think transparency, education, understanding is going to be key in the next couple of years in this market. And I think we're going to have to be really calculated with everything that we do when we look at real estate and real estate investments here in the coming years. So the good news is the fundamentals will never change about real estate. The fundamentals will never change. We will never be able to have a scenario that's better than today when it comes to real estate. That's always going to be the case. Now, will prices go up or down? Yeah, they could go either way. But we're never going to have a scenario that's better than today. You could say that 10 years ago. You could say that 20 years ago. You can say that 100 years ago. It's just always going to be the way that it works, because at the end of the day, there's less and less land every year to build on. And the land that there is available to build on is more expensive or more difficult land to build on than there was the year before. Increasing regulations for builders are going to continue to put a supply squeeze on a growing population that has millions more households than we had before the crash now, and we have millions of less homes for sale. So until something changes on that front, I'm going to be ultra bullish on real estate, and it only makes sense to be that way. It only makes sense. Anyone right now, you see a lot of these crash videos on YouTube. People are talking about the crash is coming. Here it comes. Oh, this is it. Clickbait. People who don't understand the markets, don't understand how to actually evaluate the market. You know, if you look at a market with an initial bias, you will find things that justify, what it is that you're trying to confirm. If you're looking for a confirmation of your assumptions, you will find them, because there's always things happening on both sides of every equation, okay? But if you look at it just zoomed out completely and go, all right, what's happening right now? You can see that we have a housing crisis in America, and we have inflation on top of that the Fed is just getting around to they're not even really putting in place anything to really be a solution yet. They're just starting to turn the Titanic. That's all they're doing. They've started to move the wheel a little bit in one direction. They're not headed the other direction yet. It's going to be a long turn for them. So we've got, and that means literally could take years. We may have this hyperinflation scenario that we're in right now for years to come. So be prepared for that. Don't be mad. Don't be mad at me next year if prices are much higher and you waited. Don't be mad at me. Don't be mad at me if rates go up and you missed an opportunity to refi. That's all I'm doing. I'm making it easy for myself to sleep at night by letting you know what's going on with this stuff. So email me, give me a call, shoot me a text if you want to buy a refi, if you have questions. I'm here to help. Appreciate you. Share this with your friends. Let's make them smarter than everyone else. See you soon.